you have a government shutdown, a peak probably inflation print for a number of months, them pivoting hawkish on the balance sheet, which tightens financial conditions. Like, what are these people talking about that the risks are not picking up?
There's a whole part of our country that is not doing well, like really not doing well. And all their policies are just pump the market. I'm moving from I'm so bearish, I'm bullish to like, I'm so bearish, I'm looking for the wheels to fall off here because there's a lot of indicators coming out that are making me pretty nervous.
This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. All right, everybody, welcome back to another Roundup edition of Forward Guidance. We got the trio in action. Markets are bleeding. Nothing cool's going on. Fed's pivoting hawkish. Government reopened. But that excitement faltered pretty quick. What's going on, guys?
Howdy. I liked it better when the government was shut.
Yeah, except can we go back to closing it again? I changed my mind.
Yeah.
What a pointless shutdown. It was completely useless. No one got anything done. The Democrats didn't make any ground on their ACA. Trump lost like dozens of points in his approval rating.
Yeah, no filibuster change.
What a pointless grandstand effort. Congrats. Are wonderful.
Yeah, look at these stats. 5 million airline passengers delayed or canceled. $619 billion in new federal debt. Federal statistical system permanently damaged. October jobs and inflation data may never be released. 43 days of economic data currently delayed. 750,000 federal workers furloughed. The current funding bill only goes till January 30th. So I guess we'll be doing this again in a couple months.
Great.
What does permanently damaged federal statistical system mean?
I don't know. There's a headline I saw yesterday. I think it was Hassett who said it. And yeah, some broke. The numbers broke, as in they're not good numbers, maybe.
They were never good. They were
Banana Republic. Well, they had the I think it was about 150,000 of the buyout from the Doge cuts ending in September 30th. That would have shown a huge jump in that October. That's what it is. That all the data pointed to a massive jump in October because of those workers buyouts ending and becoming unemployed. So I'm sure, number not good. So don't release number.
Yeah, you put this chart in here just showing the data. Do you want to talk about this one on what we will maybe get versus not?
This is Morgan Stanley's estimate as to when this data gets released. I mean, it's just ridiculous. Like October CPI, coming potentially in mid-December. So I don't Powell's whole like driving in the fog analogy. I mean, this is estimates, so this could all be changed, and maybe their systems become undamaged. But it's a shit show. I mean, what are they doing? Like, what are they doing?
Well, you know what? In their defense, all the data was nonsense anyway. For so long, trillions of dollars to be traded off of it. Maybe you'll just start not paying attention to it and pay attention to actual forward indicators in the market going forward instead of lagging stuff. But
well, you'd love to see that, but you have the Fed pivoting hawkish. I think at peak inflation print. I mean, another just absolute clown show from our government. Where were they all summer when inflation was slowly trickling up? This is like exact repeat classic Fed error. This last print, basically nothing changed. All forward-looking inflation indicators are showing a decline into Q1 of next year, and you have them pivoting hawkish. It's unbelievable.
I've been thinking about this a lot, and like this, the name of the show is Forward Guidance. Being so prescient is the data is so commoditized that it's almost like the actual narrative is to just fade. Whatever the data gets, super hot in one direction, you're almost anticipating the Fed to come out hawkish. It's like this inverse relationship to just reversion to the mean from narrative. And, like yesterday, there was, I think, a 62% chance of a Fed cut in December. And now it's at 50% today, and the market implodes because it's like, all of a sudden they're hawkish. 2 weeks ago, they're more dovish. And now we're going to go back to being more dovish. And it is just a sign that we're in a centrally planned economy that is just there. And everything trades off of stupid algorithms based off the VIX and volatility.
Yeah, and just like these Fed speeches too, like it's been a weird week. So here's a couple charts just to frame what Tyler just said. But Nick Timmermans has been all over it, saying for those keeping score at home, there's now 4 Fed presidents with a vote who are not actively agitating for a December rate cut, to put it mildly. This is from Collins yesterday. Says that she supported the decision for rate cuts last meeting, but based on her baseline outlook, it'll be likely appropriate to keep policy rates at the current level for some time to balance inflation and employment risks in this highly uncertain environment. Says downside risks and employment do not seem to have increased further since the summer, which is kind of funny because we haven't really had much data to go with. I mean, back then we were talking about how the risks of the labor market were probably overstated, but nothing has actually changed in that overstatement other than just the vibes. And now the vibes
a month and a half government shutdown by the biggest employer in the nation.
Yeah. It's just noise.
The speeches, these people, it's crazy. I mean, her speech is crazy. I mean, I think the most, honestly, Moran is rising, I think is probably the most respected because he's laying out articulate views week after week in public forums, saying, critique this. No one else lays out any reasoning behind views. And his interview with Jack on Monetary Matters was fantastic. And it was exactly what we talked about last week or the week before, which is the balance sheet policy shift was hawkish. He literally said, this is not dovish. He basically said this is hawkish by, tightening duration, putting more duration in the market because the MBS runoff. So you have a government shutdown, a peak probably inflation print for a number of months, them pivoting hawkish on the balance sheet, which tightens financial conditions. Like, what are these people talking about that the risks are not picking up to the downside? And, this is coming from someone who I didn't think they needed to fuel the bubble all summer. I mean, they were fueling the bubble all summer. And then,
we know it's
going to pivoting late.
You're going to get,
they're going to pivot again. Yeah.
We're close to a VIX inversion. Credit has tightened. And maybe we should go through a couple of the charts that I have. We could just talk about the phenomenon that's going on. So maybe hit me with like 32 to start. So I think this is what queued it up, is obviously the fixed thing, got to watch fixed income supply is Oracle. There's a bunch of big bond issuances. And I think, the oversupply of these bonds for AI infrastructure kind of caused some rumblings where credit spreads kind of backed up a tiny bit. Then if you go to the next chart, we saw, I don't know what it's exactly taking into account for the tech CDS, but Oracle CDS has been blowing out to the upside, meaning credit spreads are widening for Oracle because they're levering up, right? They're borrowing a lot from fixed income to build out this infrastructure now. So a lot of the arbitrageurs, they go out and short the equity once credit spreads actually, widen for specific stocks. That caused Oracle stock to kind of roll over. And now if you go to the next one, you can kind of see this is actual Oracle CDS, which is very correlated with that last one. But if you go back, you can see we're kind of at levels specifically. No, I meant if you go back to 2000 when, credit spreads really blew out, and then back during the pandemic, credit spreads blew out then too. So this is pretty substantial where people are basically calling the top of the AI bubble in a lot of the AI infrastructure names. And we saw, we did kind of warn you here where when everyone was YOLOing into call options of a lot of these stocks and quantum computing, that this is a risk. So now we're seeing actual credit risk in this, in these sectors, but we don't know if that's, a full on, is this going to be a bubble bust or is this just going to be, all right. Cause Oracle obviously has had a lot of cash flows. It just needs to digest a little bit. but there will be a lot of supply. Like JP Morgan put out this incredible report on how much supply of fixed income has to come to market for all of this AI infrastructure over the next 5 years. It's like, it's an insane numbers. You're talking like trillion, $1.5 trillion over like the next 5 years that this investment grade market's going to have to eat up. So theoretically, like spreads should widen here. And I think that's what we're seeing. Whether it turns to a bigger problem, I'm like, my whole thing was like, I'm so bearish, I'm bullish. This is making me like, I'm in this like neutral zone right now where there's some things that are still game on. Like if you look at the Dow, it hit like an all-time high yesterday. There's definitely rotations under the market that are actually doing well. Like gold miners doing incredibly well, gold doing incredibly well. But like the tech, you got to be careful on a lot of these like retail centric themes, especially if they're not even making revenue and the credit markets are tightening for those specific names now. So that's,
I think what's like being underwritten here is there's been this, we've been talking a lot about it the last few weeks, which is just this transition of these Mag 7 companies to go from companies that for years have just been spitting off free cash flow and just either doing stock buybacks or what have you, or dividends. We've seen that trend emerge in the last few years from these tech companies. And now we're seeing this transition towards either the free cash flow gets used to fund this AI capex, and then that was all good and well for the past couple of years, but now we're starting to see this transition towards funded by debt issuance. And then as we start to fund by debt issuance, it makes sense that CDS like this has to be repriced because there is that incremental increase in default risk basically. And so I feel like it's the market trying to digest this transition point where it's no longer just basically this free money machine of AI capex build, but it's starting to be built out more by debt issuance. And that just changes the complete landscape of what has been so compelling about these Mag 7 names, which is just like absolute monsters with a ton of free cash flow that they can just do endless buybacks with. And that game's changing right now, I think. If you're thinking about crypto investing but don't want to open a new account or manage keys and wallets, check out Grayscale. Grayscale has been offering trusted crypto investment products for over a decade, with 30 and plus counting, including single asset funds like Bitcoin and Ethereum, diversified portfolios, and thematic exposure to the broader digital asset space. Many of their products are available directly through your brokerage or IRA, just like a stock or ETF. Investing involves risks, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
If you think about it, though, like it doesn't necessarily have to mean the bubble's over yet.
No.
Because there's a lot of like, think about that money that Oracle raised is going to go to spend somewhere else. So you get this money multiplier effect on the debt that's raised. It's just eventually, if it becomes restrictive where a lot of the plans they can't build out based off, where credit is allowing you to issue, which is partly the government's, this is why the Fed is so important and why the hawkishness this week, added on to the credit stress is they really need the Fed to back this thing. That's the truth. For this to come to fruition over that period of time, you need a government to provide the liquidity. And right now we hit a bump on, not only was it the supply came to the market, that was a lot, but also it was, not unintended, but Fed hawkishness really repriced here in December, odds of easing. So those two things caused this spike in volatility, and credit spreads widened out a little bit. It's really actually pretty scary. So now check this is 31. So where I was a couple weeks ago, where I was like, things looked like they were rolling over, it's starting to add up that more problems are arising here. And so there's this article, this is from one of the guys in our Twitter channel or Telegram channel, Grant. He sent this to me, which is a good article in Bloomberg. Basically, this is a private loan that's marked differently on all the different private equity guys' books. So you can see on the right-hand column, this is, in June of 2024, they're all marked it at basically 100. And now credit is deteriorating on this one private credit loan. So if you look now, Blackstone marks it at 82 cents on the dollar. Apollo marks it at 70 cents on the dollar. KKR still marking it at 91 cents on the dollar. So like this kind of reminds me a little bit of when I was at KBW, which is an investment bank during the subprime crisis, we were seeing non-performing assets kind of rise a little bit. And this is in like early 2007. And the non-performing assets were going up, meaning like the credit was starting to tighten, but people didn't really punish the stocks yet. And I'm seeing this and I'm like, antennas are up. Then when you see stuff like auction rate securities, the auction rate security market froze up in 2008. And if this is worse, we will see something like that happen here. Like the reserves for the Fed are actually rolling over in terms of, where they have. So they really probably need to do more monetary stimulus to keep the credit cycle going here. And I'm getting incrementally less bullish. Then go to this. This is slide 35. There's two more charts I want to show you. So this is expected financial situations. This is from the University of Michigan, 5 years out. Everyone, the red line is just like so bad. Look at the dispersion here, which is first off crazy. This is where the K-shaped economy really comes home to roost. Is like there's a whole part of our country that is not doing well, like really not doing well, and they can't.
Majority.
All their policies are just pump the market. Like it's the whole. In this is why you have Nick Fuentes gaining a lot of popularity and Mamdani gaining a lot of popularity. It's the inevitable result of when you think money printing, you have two extremes now. And
I feel like the spread here between these two charts is like unrealized inflation. Like that's what it's capturing.
Yeah,
that's crazy.
Great point. And then if you go to the next chart, slide 36. So the Americans behind on car payments, like you're really seeing. So this is subprime borrowers. Part of the economy is just not functioning. And I said this publicly on Twitter, but I was like, the social contract is breaking here. And you can kind of see it in the politics, obviously. That's like where it's most potent and obvious. Generationally, I think you're seeing a lot of angst because a lot of the policies have been beneficial towards boomers or older generations with assets rather than younger generations. And so this is the battle of our times. And what works well historically during these times is gold, and that's really, I think, what's working. And Bitcoin is actually not working like it should here. Maybe it's an early indicator that there's deflation, but I think gold is telling you in this next 10 years, I don't know. It's acting like the better performing asset so far to me. And I don't know. There's a lot of funky stuff going on, but it's making me less. I'm moving from I'm so bearish I'm bullish to like I'm so bearish I'm looking for the wheels to fall off here because there's a lot of indicators coming out that are making me pretty nervous. When you see like the quantum computing sector get absolutely waxed, that hurts a lot of retail, and retail has already been hurting, in those surveys. And this is when you go from like, this is your last ditch effort. Like Bruce Springsteen, Atlantic City song is like, this is my last way to like YOLO into making up the gap of my earnings or whatever it is before I go bankrupt. I think that's what we're watching in real time is those sectors were what would keep the retail investor above the inflation. And now it's rolling over. So we'll see if the Fed might just come in and go balls to the wall and we're back at new highs, but it's kind of weird.
I think on that note,
they'll put down the Robinhood apps and pick up the pitchforks.
Yeah. I think right now reminds me a lot of December 2018. I'm curious if you guys think that. So this is a chart from Roberto Perli, who basically runs the SOMA account at the Fed, at the New York Fed. So he's the guy that basically manages the Fed balance sheet. And he had a great speech this week. And in that was this deck of just some interesting charts on the plumbing markets. And the last one was this spider chart, which I found really helpful for just understanding where we are at in that wheels falling off the cart kind of situation you just mentioned, Tyler. And you can see the light blue line in June, that's where reserve ampleness was back then. And we've been there for the past 3 years, basically since the huge COVID boom of QE. And you can see from June to October, we've just seen this meaningful transition to the lower left here in terms of strain. Now, we're not quite as bad yet as September 2019, where you can see like these areas started to get pretty extended and concerning. So I think we're well underway in that process right now. but I don't think it's over yet. And I think this is why you're seeing so much talk. We've had the New York Fed President Williams come out this week and say that, they need to start expanding the balance sheet like pretty soon. I would not be surprised if they announced that at the December meeting, honestly. I could see this situation where it's kind of weird, actually. Maybe we could talk about this, but on one side of things, you have them being hawkish on Fed funds rate and looking to potentially skip December, but they might be a bit more dovish on the balance sheet. And then you pair that with what like Marana has been talking about, which is that hawkish balance sheet situation Quinn was talking about earlier. You have Besson has been talking about for a while now, and likely what they're going to look for in a new Fed chair is somebody who lowers Fed funds rate pretty dovishly, but is looking for a more hawkish reaction towards the balance sheet. And it'll be interesting to look at December because I feel like it might be the opposite of that. And then we'll see that reaction into 2026 when you have the new potential Fed chair coming forth.
I think that's right. The problem with that is that a steepener hurts the parts of the markets that have been winning. I mean, the thing also I find so weird about this hawkish Fed pivot, why not use the press conference? Was it 4 governors that came out and said they disagreed and dissented on a cut, and then they did it? This is like,
there's a couple of them that said that. I think it was Logan.
But where were the dissents? Like, what are you talking about? Like, you're trying to rewrite history. Why is this information not like, oh, we dissented on the cut, but we did it? What? But I have a couple of charts, Felix, I want to go through, just kind of frame something, because I have an idea that and these bubbles like are tough because they're so reflexive in one direction, right? So you have like Fed pumping, Treasury pumping all summer, fueling this bubble talk. It has became a pervasive narrative, and it can take one thing to reverse retail liquidity, market structure, all these things in like a dominoes. And it's both ways, because that's like what bubbles are. They're super reflexive either direction. And when everything's so fueled by hot air from the Fed centralized liquidity, that's what happens. But if you go to chart 16, just to rip through, I'll be quick and we can just rapid fire some of these. But it's Palantir's forward price earnings, almost 250. It's basically like the largest PE for a $500 billion company. You have the price to sales at 87. On the next chart, it shows NVIDIA, breaching 5 trillion. The next chart shows the largest weighting of the S&P 500, NVIDIA 8.6%. We're making records here. Next one is weighting of the top 3 holdings: NVIDIA, Microsoft, Apple, making a record at 22%. Top 5 holdings at 30%, and the top 10 holdings at 40% of the index. So this is the big thing to like really delineate in your like, is this a bubble? Is this not a bubble? Is that all bubbles look different? And call what you want, but in .com, when everything's like trading at super elevated multiples and tech is a very small portion of the economy at the time, it's a much, yes, those multiples were more exaggerated to the upside, but it's such a much smaller significance of the total economy and stock market. Here we're talking on the next one, 40% of the top 500 companies are in the top, or even the next one, in the top 10 companies. So I posit, one, this is a national security threat, because your stock market, your whole pension system, the whole wealth of your nation is tied up in 10 companies, most of which have serious China exposure. China.
So and now they're levering up on top of that too.
You put it that way, it's so spot on. Like, these need to be broken up. You can't have that.
That's not even the worst part of this. So one, it's an extreme national security threat. China has the US by the absolute balls, because these companies are driven, like NVIDIA is begging Trump to open up China. Apple, 25% of China. Tesla, 20% China. NVIDIA, Taiwan. What happens to NVIDIA if China did something on Taiwan, or even threatened it, right? That China doesn't have to move a single ship to cause absolute havoc in the U.S. stock market. Okay, so no resilience. So it's a huge national security threat. The second thing is, everybody knows these are monopolies. Like, it's horrible for entrepreneurs, Main Street innovation, and the CEOs basically brag about it being monopolies. I mean, the investment thesis is these are monopolies, and they should have been broken up a long time ago. What happened to the CFTC chair Brendan Carr that Trump had on his team, this guy was fighting Mag 7, trying to break, like, that was totally thrown out the window. And then the third thing that I just would say is, like, so it's, the monopolies are a threat to Main Street. And the last thing is, these guys are the epitome of the wealth inequality social fabric problem. And so I would posit that in addition to maybe inflation or growth or whatever you want to throw out there for 2026 is a risk, is like, okay, yes, the Fed might print everything and it be hunky-dory, and we should probably have that as our base case because that's what they do, and Mag 7 will rip again. But the thing is there's a growing chance, particularly after Democrat big win in these elections, and we all know what wins in this populist environment is spending, that these guys become public enemy number one, because you have to channel this hate against and angst against somebody. And as if moving into a midterm election year, politicians' number one goal above all else is reelection. Like, throw everything else out the window, it's reelection. And there's a world where reelection comes from not just like, it could be the total rug pull. I'm not saying it's going to happen, but there's a percentage of that happening.
I think your bigger risk is a guy like, like, look what happened under Biden is the fangs got bigger and bigger and badder. And then they decided, oh, we're going to decide which companies rule AI. And then it's a centralizing function that really, centralization is really scary on both the extreme left and the extreme right, which is why we need to break these things up. Like, that's the really scary thing, is whether it's Nick Fuentes that gets in office or Mamdani. Like, I'm thinking about the politics, and this is where I've been roasting boomers. But, like, when you get this centralizing effect across the economy and you bail out assets for 20 years plus, this is the end result, is the politics get nutty. And you don't want centralized platforms when the politics get nutty, because then you get crazy historically. Like, you can scale a lot faster as, a crazy fascist or a crazy leftist. This is why America worked for so long, is because it was decentralized. And, like, to your point, I don't think anyone's framed it that way, but, like, your entire 401k system is levered on this now. And you can't, I don't know if you can unwind it. I don't know how you unwind it, but it's kind of frightening when you think about it.
Yeah. And I think that's what the market's trying to digest right now. It's just the shift of, like, that 40% weighting is now moving into levered. Like, their balance sheet is becoming more levered. It's not the free cash flow machine they were for the last 10 years. And that will take time to digest. I think you can have that happen without the bubble completely popping, as long as there's, like, a decent foresight into where the top line growth and, like, revenue growth is going to come from. But, valuations and credit spreads need to re-rate to consider just this default risk that is new and emerging. If you're thinking about buying crypto, but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
And you know what? I guess the goal of this whole thing is AI works. It's massively productive. You have whole new industries, and people grow new companies, and that naturally decentralizes the power structures, even though they are a tax on the rest of society per se. You have these massively more productive things that come of it. That's a great argument for why we shouldn't, break apart these things. But I don't know. I'm looking at the politics and I'm thinking it's only going to get worse. I don't know how you put the genie back in the bottle now, where the rhetoric's going. And that's where I think it might have to break before you actually fix it, and you get some strong leaders in there to actually say, like, these jokers that are actually in here right now have zero incentive for the people they govern, and it's just a giant kleptocracy against the middle class. Like that's where I get really angry, is at the end of the day, like, how do teachers survive? How do cops survive? How do firefighters survive? Like, that's where I'm thinking, like, I want to live in a community where I have just as much respect for those guys than anybody else, and have like, and grow families. Like, that's what everyone wants in America, but no one seems to want to create that as a politician. Who the F is running for office? Like, how come these there's, and the truth is no one wants to fund those ideas. You have to actually grassroots fund those, because otherwise it's not gonna work. And then when someone breaks through, like AOC, who should be that, she gets, co-opted by the corporatists. And you're like, so it's really hard to have, like, that's why I was like, I was saying Tim Tebow. We got to get like Tim Tebow running for office, because that guy's
That's true.
If he's got some dirty stuff under there, then I will lose all hope for humanity.
Yeah. I think that's what's so hard, is like the pressure for re-election will just sway incentives in that direction. Like, you can see, this idea of, say, being more dovish on Fed funds and hawkish on balance sheet, like, that is a good thing for wealth inequality. But then you also have the situation where they're talking about throwing out $2,000 stimmy checks and tariffs because they're worried about midterm election, and that is going to be terrible for inflation, terrible for everyone. But you have that carrot being dangled because they want to be reelected. So like, that goes completely against what they're trying to do. They're talking like, it's the exact same thing as like the Biden's Inflation Reduction Act. Like, you can't throw money as a way to fix inflation, but they want to be reelected.
I feel like we're watching the end game. Like, this really feels like the fall of Rome. And I used to be really bullish on it, and I'm just now my bearish side is coming out. More so because Bitcoin isn't decentralizing shit. It actually feels co-opted. Like, I don't know why in this environment, this is why it's created, and it's not doing what it's supposed to do. And in fact, you're probably getting more and more, you get the short vol guys in there, manufacturing yield, and then you get the DATs, and it's perverted. So it's probably why the OGs are all selling.
And yeah, I was going to say that we should talk about the OGs selling, because they are the ones that came in on that vision, and they are the big marginal seller right now. Feels like every week, we got a new headline where a cold wallet that hasn't been touched in 10 years is selling $1 billion of Bitcoin. You got to ask yourself, like, has the vision strayed? Because it's not working as that hedge that you would hope for it to be. And maybe it's just transitory. Like, that's the bet. And I'm still cautiously optimistic on it. Like, I don't know about you guys, but I still think the debasement trade will be back in earnest in 2026. It's just about getting there in one piece. Right now, we're in this moment where, December 2018 is a good analog for me right now. And you just need to get to there in one piece. But I'm still a believer in it in 2026. I think it's going to meaningfully accelerate. What do you guys think?
Everything about this is a concerted bubble deflation effort with the primary objective to create as much fiscal and monetary space for stimulus as possible leading into the midterms, is how I would frame it. So what do you have? You have a completely bullshit, no progress, no breakthrough, nothing, manufactured extended government shutdown for 45 days. That could have never happened. That puts a bunch of cyclical downward pressure. You have, presumably now's a perfect time to distract from red markets to go do something in Venezuela. But you're going to get some more oil, everything they're doing all year is to reduce the price of oil. And then you have the Fed pivoting hawkish at a time when growth risks are probably accelerating compared to other times they could have done this. And all those together are dampening that forward-looking inflation outlook. So a lot of some of the best inflation people that I follow are pointing to lower inflation expectations over the next 3 to 6 months pretty substantially. And so what this does is basically, it corrects the markets, whatever it does. It takes liquidity and air out of the system now. But then what it does, it gives them room to cut multiple times leading up to Powell's departure. Powell's gone. They have even more, leeway to stimulate under a Trump-appointed Fed chair. And then they also, because of the lagged nature of when you cut and add liquidity and when you add fiscal stimulus, that takes months to flow into the inflation metrics, right? I mean, these things are delayed months. So if you're looking at stimulus that's happening in Q1, Q2, that probably doesn't show up in inflation numbers until after the election. So I think they're creating this room to be able to really floor it next year. And if you go to slide 23, I just have a couple quick charts that just, it's like these Fed chair members don't even have a process. Like none of them, I mean, you question if they have any markets expertise, like experience at all. And just, it's not like textbooks, but this is a perfect case shape. You can see the lowest quartile median nominal wage growth is getting hurt the most by far. And notice what happened in 2022 when it was the lowest wage quartile growth that was skyrocketing. Can't have that.
That is insane. You can see real wage growth starts to pick up for that income class, and then they're like, no.
Yep, no. You got to go back to your dungeon. Yeah. And then the next chart. This is what's also laughable about them saying like, oh, the labor market's fine. And granted, this data, whatever, it's a point. I'm not saying this is like you rest all your laurels on like a Challenger report, but it's showing weakness. I mean, the small business cohort of the ADP negative. On the next page, median home buyers is like the highest ever age, 59 years old.
This one is this floors me.
And then the next one, if you go to the next one, you have it culminates in this. I mean, people are pissed off. So Trump's approval is going in the gutter, and then you have like these Fed people going up there and saying, "Oh, the economy's fine." Well, it's not fine aside from the low income, but everything else is fine. It's like, dude, the low income is 50% of the country. The middle class is the other 30-40%. Like, you're talking about the whole freaking population.
I gotta say,
noting it.
If you rewind to forward guidance before the election, it's like Trump hasn't done anything he said he was going to do, like in terms of, I shouldn't say all of it, but like
very little.
Yeah, to keep things fair, like for the expectations of like what he was.
Oh yeah, inequality's gotten worse.
Oh, it's gotten way worse. And that's like my number one issue personally is like, I actually want to live in like a civilized society that's not, has some sort of reality. And it's just gotten so bad. And I don't know how you put the genie back in the bottle now. Like that 59-year-old thing, like can we go back to this chart? I just love
crazy. Like, how could you ever, like, that's why the birth rate is like plummeting here. Cause you can't afford a family. Can't afford to
that's sort of exactly what I say is like I've been engaging a lot of boomers on Twitter on this stuff because they're like, we worked hard for that. And I was like, I know you did, but the last 20 years you didn't really. You kind of bailed yourselves out. Like you kind of printed over all this stuff when like the natural free market should have reset. You should have reset valuations and then had let the natural cycle happen, but we didn't do that. And now we're in this weird world where we're talking about the balance sheet and duration mismatch and kind of QT. And you're like, we just printed $15 trillion between monetary and fiscal. And this is what you get. The average home buyer is 59. That's nuts.
And you had the Fed buying mortgage-backed securities. Like they have admitted that was a mistake, that they shouldn't have done that. And they were buying MBS and over fist. Like
ridiculous.
Yeah. These people are in the iron golden thrones, and it's just.
I'll say boomers are probably right. Yeah, there's some laziness. Like we grew up with the internet. Millennials, Gen Zers are probably pretty lazy relatively, but there's also got to be an incentive, right? And there's so that's my point. Is like when a lot of people are voting for Mamdani, you're not incentivizing them, right? There's clearly not like they will probably hustle if they have some sort of vision of what it would be like. But I don't think a lot of that hustle you get paid for anymore. So that's what's happening.
Yeah. Also, the boomers, it's like, the younger generation, they're so lazy and stupid. It's like you locked them in their fucking parents' basement for 3 years during their formative years during COVID. And you said, you can't do more in-person stuff. You can't socialize and you can't progress. Like, no wonder these people can't operate in professional settings.
It was a real shock. I told this to a bunch of boomers, but I was like, if you're actually younger, being on the right is the counterculture now, meaning like, and they don't understand it. Like it can't, it's like, I was a hippie against Vietnam. There's no way the up and coming generation is like more conservative. They can't wrap their heads around it. It's fascinating.
To be honest though, I would question that. And because I'm increasingly knowing people who like, I mean, this Trump approval thing who are like, look, I'm happy about the immigration thing because that over time should help lower class wages competition. I'm happy about the tariffs thing because over time that should bring manufacturing jobs back. But when you mess with the money supply and support asset prices at all costs, it throws all the progress of that stuff out the window because that is the single most levered lever to affect inequality. It doesn't, so no one's ahead. And so I know people who are who are like, well, I can't vote for Cuomo because he's another person to throw us in that direction. I just want, I think that populist movement, I don't think even people are going to start caring what side you're on as long as you're just, unthroning the system. And really how this has to happen when 40% of the S&P is in 10 companies is what's happened in housing. What happened in housing since 2021 bubble? Well, basically housing prices have gone nowhere in 4 years. I mean, they've basically been flat to like 1-2% down. And that doesn't cause a catastrophe economically. And that's basically what you need, Meg 7. You need this stuff to just flatline in real returns to be drastically negative to allow the wages and the lower middle income class catch up. Because your other alternative is they will burn it down. So pick your poison here.
Yeah, housing and mortgage rates, that's a good example of just where, we've seen talk come out of the administration where they're like, we need to lower mortgage rates, but they try, and it's really hard to do with where the economy is at right now. Like, I think it's at fair value and we need to just let it churn through. We've had bond yields and, people have been calling for 5% 10-year and higher. They've also been calling for 4% lower 10-year. And the fact is we're just chopping at these highs and the economy is slowly working itself through it. And I think, we just need to continue to let the free market do its job and let long end rates find equilibrium. And if that means that housing prices need to come down to have equilibrium with where mortgage rates are at, that's what should happen. Now, of course, there's the whole boomer Ponzi thing that Tyler talks about, which is that you can't let housing prices go down because that's people's retirement plans. Like, I'm in Canada, it is literally all anybody's savings is their housing equity. You can't let that happen. So I don't know.
I've been thinking about this, the equity thing a lot, meaning like what's really hard. It's hard to invest over the long term when there's so many systemic problems. So like, it's easy to sit on your house when you have, 70% of it is in equity and 30% is in debt, meaning like, oh, you can just rent it out and pay off the last little bit. So you become as you build more equity in things, you have an easier time holding it and not selling it. The problem with the economy for, millennials and Gen Zers is like, every dip that's systemic, like 2018, 2020, like it shakes a lot of people out, right? And if you didn't build up an equity buffer to at least hold during those times, or understand what's going on and know that the government's going to come in and bail you out, it's really a messed up, system, because the ones that hold the more equity in those things end up scooping up all the weakness because they have the ability to. So it's a naturally centralizing process, right? If that makes sense.
Yeah. I mean, even in April, we saw that repeat itself. And
yeah.
Yeah.
But you should have defaults. Defaults should be natural. That's the real hard part about all this for me, is like, you're either a sociopath in private markets telling a fake story and, trying to raise as much money as possible and growing, theoretically growing something real, or you're doing a SPAC with zero earnings and you have a multi-billion-dollar valuation. It's like, but there's nothing really behind the curtains in those companies. It's the whole market structure needs to be like revisited as a national security issue, because it's not, and it's partly the fact that there's like 10 asset managers ruining the market structure. Those BlackRock should be completely, unwound into 10 different companies. So same with every single giant asset manager. Like that's actually monopoly risk, but no one thinks like that. It's why, it's so anyway. Well,
that's why you need crisis. That's why you need crisis, because these the tightly held control will never go down easy. When that's like what monopoly ever raised their hand and said, you know what, I want to unwind and split up? Like what? Never. So you it's prevalent, like you said. It's not just tech, it's every industry that the power is centralized, and the only way to infiltrate that is like economic or physical violence. Like,
well, I've been thinking about this philosophically. You know what breaks the centralization is the Epstein list release. Like that's the only thing. It will be a new first turning when you actually get to see what creeps in society have been keeping this under wraps. I really mean that.
The problem is it's literally all of them. Like every
it's bipartisan. So who wants to release it?
And so it's gonna be centralized. We'll get more centralized till we're in like Brave New World, Mustafa Mond, like world controller stuff. And something's gonna, like, this is Hunger Games. This is totally Hunger Games, Art Mimic's life, where you have like it's fascinating.
Eventually somebody will get elected that is not part of that whole thing, and we'll release them eventually.
Which was closer than we think, because that was what everyone wanted with Trump.
Yeah.
But they got masked by their bias.
Well, they wanted it, and he pandered to it, but then he went in and it's like, oh wait, he's on the list. It's like he's not going to release the list. He's on the list.
All this stuff is you know what it is? It's all just cartels. Like at the end of the day, this is how drug cartels work. They get you if it's not you that you're co-opted, it's like someone you're close with, and they use it against you. And like you could, if I'm telling the truth now and someone points a gun at me behind the scenes, like obviously like that, it changes the narrative. That's exactly what we're dealing with. They're just centralized cartels.
The problem is that youth unemployment is like pushing 10%. And I mean, how many more years do you really need of that? Like, let's say that rises another 1% to 2% every year for the next 4 years or whatever. You're looking at, I mean, we're talking like within 5 years that like the youth cohort is like 15 to 20% unemployed. You're probably right there at that. Like you're very close to that moment. We're talking years, so we're not talking tomorrow, but politically, you're very close to this moment where those people have no assets. They have no allegiance to the social contract because they're getting screwed. They have no buy-in or skin in the game. And so that's what people don't understand is like desperation and no ownership, no equity in the economy, no you give and you don't receive. Like there's no, like you start wanting destruction. You start wanting, you're not voting for the best person for the country. You're like, and that's where people get wrapped around the axle. Like, oh, Medmani, like, oh, he's going to be terrible for the economy. That's the point.
If they said Medmani.
What is it? Mendani?
What is it? Mumdani.
Okay.
I think
that's the point of these people. That's the point. Because it's like, well, F it. I don't care. It can't get worse for me. I'm eating ramen because I can't afford groceries for a salad and healthy food. Like I'm dying on the inside from this garbage nutrients that American food has become. I make $7.25 minimum wage an hour. Like, yeah, like people don't care. That's the point. They're going to want.
I think the suicide rate's going up too. It's like at an all-time high for working age people. There's
all these things are related. Like, yeah, and it's tough. All right, I think we got to leave it there. I got to jump off, but pleasure as always.
On a positive note. We got to end it on a positive note.
Yeah. Okay, say something positive. Say something positive. Real quick.
I miss your Matisse paintings.
I know. Yeah. I'm in my new office, but I haven't had time to set up anything, so I just look like I'm in a psych ward. But we'll change that soon.
Yeah. I think our bearish, if this might have marked the bottom, just in case. Let's end on that. Hopefully it's all up from here. Inflation stays low, productivity boom, everyone's doing better.
Yeah.
You know,
Also, if we did bottom and we run up, I actually bought the bottom, by the way. So just
Yeah.
people know.
We're a couple weeks from the holidays, and regardless of what's going on, that's a really great time and reason to be reevaluating the things that are most important. So I'm looking forward to the holidays. I think everyone, after this year probably is.
I miss that New York City holiday season. I don't know if you're up. Are you in Florida?
Yeah.
For it? Yeah. Okay. So not as cool. It's weird seeing like holiday lights in warm areas. It's not quite as.
I could never understand that. Yeah.
It's cool for a bit though. But yeah, New York in Christmas time, man, is goated. I mean, the vibes are incredible.
Yeah. You gotta love it.
So good. All right. Have a good weekend, guys.
Take care.
You guys.